Hey guys, it's Mrs. Invest. So I heard you loud and clear in the comments. You wanted a video on options trading. So, you asked and I deliver. Here we are. Today's video is going to be all about call options. So remember in one of my previous videos how I was talking about ETF investing and how I love it. It's awesome, but sometimes with ETFs, you need toothpicks to keep your eyes open because they can be so boring. And sometimes you just need a little bit of spice. And so that's where options come in. So let's get right into the video. So what is an option? And there's basically two main categories of options. There are call options, which gives you the right to buy a stock at some point in the future at a predetermined price. And there are put options, which give you the right to sell a stock at some point in the future at a predetermined price. So in this video, we're just going to be talking about call options because just talking about call options is going to be a really long video. So what stock, what price, how far into the future? Well, all of that is contained in the options contract. And one options contract gives you the right to buy 100 shares of stock at some point in the future. And all options contracts are like this in batches of 100. So one contract is 100 shares, two contracts is 200 shares, and so on. And in every options contract, there is a strike price and a time to expiry. The strike price is the predetermined agreed upon price that you have the option to buy the stock at some point in the future. And the time to expiry is how long from today you have to exercise the right on that option. And when I say exercise, I don't mean using the treadmill, I mean doing what the option contract gives you the right to do. It's called exercising the option. So for example, you can buy one call option for 100 shares of Tesla stock to buy Tesla stock at $600 a share 1 year from today. And let's say 1 year from today, Tesla stock is trading at $900 a share. Using your option contract, you can still purchase 100 shares of Tesla for $600. Sounds pretty good, right? So in this example, $600 is the strike price and the time to expiry is 1 year. Okay, and the next important concept is something called moneyness. And an option contract can either be in the money or out of the money. So an in the money option contract is when the strike price is already lower than the price that the stock is currently trading at. So for example, if your strike price on Tesla stock in your options contract is $500 a share and Tesla is currently trading at $600 a share, then that means that that option contract has what's called intrinsic value. It already has value today because of course you want to buy Tesla at $500 instead of $600 a share, right? So because of this, the premiums on in the money option contracts are usually more expensive, but more on premiums in a little bit. And the second type of moneyness is out of the money. And this is where the strike price is higher than what the stock is currently trading at. So for example, if the strike price of Tesla is $700 and this Tesla is currently trading at $600, then that option contract really has no value today because you wouldn't want to use the option to buy Tesla at $700 when you could just buy it at $600 a share on the open market. So for this reason, the premiums on out of the money option contracts are usually cheaper. So to give yourself the right to buy something in the future, no one's going to give you that for free, right? So you have to pay what's called a premium for that option contract. And the premiums are listed per share, but remember, one option contract is for 100 shares. So the total cost of your premium for one call option contract is going to be the option premium you see multiplied by 100. And options have ticker symbols just like stocks. So let's look at this option contract right here. So it's for Tesla stock. The expiry is August 20th, 2021. And it's a call option, which means you are paying a premium for the right to buy Tesla stock at $620 a share, and the premium you're going to pay for this call option contract is $73.95 per share. So multiply that by 100, and this call option contract costs $7,395. Now I just picked one for an example. Not all call option contracts are this expensive, but I literally just picked a random one. So remember that you have to multiply the premium by 100 to get the full cost of that option contract. And these option premiums are listed out in huge tables on your brokerage website called option chains. Now, if you don't like looking at a lot of numbers, grab a Pepto-Bismol because you're probably going to get nauseated, but let's go there right now. So on your brokerage website, I'm using CIBC Investors Edge. You should see an option here that, no pun intended, that says view full chain or view full option chain. So you click on that. And then for some reason, you have to type in the symbol again. And then you can list it by the expiration date or whatever you want. So you can pick an expiration date that's sometime in the future and then click apply. And you can see all the expiration dates organized by date. And let's say you want to see the chain for June 25th. So you can see all the call option contracts listed in order of increasing strike prices and the premiums associated with those contracts, as well as the change in price for the contracts. So what affects the options premium? I'm so glad you asked. There's three main things: the strike price, the time to expiry, and the volatility of the stock. So the strike price, a premium is going to be higher for a lower strike price, right? Because if you think about it, it makes sense that if you want the option to buy a stock for a cheaper price in the future, that's going to cost you more today than if you want to buy the stock at a higher price in the future. The second thing is the time to expiry. Option contracts with a longer time to expiry, so a date that's farther away, are going to be more expensive than option contracts with a shorter time to expiry or a date that's closer to today. Because the longer you have, chances are the stock is going to go up over time. And the third thing is stock volatility. So for stocks that are extremely volatile, again, chances are the stock is going to move in your favor at some point compared to a stock that mainly just trades sideways and doesn't really move very much. And so for that reason, volatile stocks tend to have higher option premiums as well. So what's the benefit of call options over just holding the stock itself? Like, why go through all the trouble, right? Well, basically options give you leverage. So they allow you to amplify the benefits while requiring less capital than would be required if you just held the stock itself. So to illustrate this, let's use an example. So let's say you have $5,000 that you want to invest with and you want to invest it into Apple stock. So on the left side here, you could just go outright and buy Apple shares. Let's say they're trading at $125 a share. That means you can buy 40 shares of Apple stock. And let's say over the next month, the price of Apple stock goes up 10% to $137.50 per share. Well, if you bought 40 shares, your shares would now be worth $5,500 and you'd have a net $500 gain at the end of the month on your $5,000 investment. So instead, now let's look on the right side and say, instead, you took that $5,000 and bought an Apple call option with a $125 strike price with a premium of $5 per share. So with $5,000, that means you can buy 10 contracts because each contract will cost you $500 or $5 multiplied by 100 shares. And let's say Apple stock does the same thing over the month. It goes up 10% to $137.50 per share. Well, your net profit in this case would be the price of Apple shares when you decide to exercise the option, minus the strike price, which is $16.50 per share. Now, because you have 10 contracts of 100 shares each, that's essentially 1,000 shares of Apple stock multiplied by your profit of $16.50, which means you have a $16,500 net gain at the end of the month compared to a $500 net gain if you bought the shares outright. So let's go over how to use call options, how to make money with call options, and 3 call option trading strategies. Number 1, buying a call option. Number 2, selling naked calls. And number 3, selling covered calls. So first, let's go over buying a call option. And let's go back to our example of the Tesla 20th of August $620 call. So first, what is this call worth at expiry? Well, basically, you've bought the call option, which is a bullish bet on the stock. You think the stock is going to go up. So the higher Tesla stock is when this call expires, the more money that you'll make. So if Tesla is trading at $720 when the option expires and your strike price is $620, that's $100 of profit multiplied by the 100 shares in the contract, which gives you a $10,000 profit. However, if the strike price is greater than the share price, so Tesla stock went down below your strike price, this call option is basically worthless and you're going to be out the premium that you paid, or $7,395. And your cost of this call option is the premium you paid multiplied by 100. So in this example, it's $73.95 multiplied by 100, or $7,395. Your net profit with this call option is number 1 minus number 2. Another important thing to note is, what is your break-even point per share? So your break-even point is your strike price. So in this example, it's $620 plus the premium that you paid per share, or $73.95. So your break-even point by the 20th of August 2021 is $693.95 per share. If Tesla is trading below this by the expiration date, you will lose money. If Tesla is trading above this by the expiration date, you will make money. And the higher Tesla is trading above this price on the expiration date, or at any point from now until the expiration date, the more money that you'll make. And here's a graph that I drew up about this particular call option. And if you're just starting with options, I really suggest you do this, especially if you're a visual person, because I think it's really important to know ahead of time, before you buy the option, what your maximum loss and maximum profit potentials are. So for example, for this call option, your maximum loss is the premium that you paid. So if the worst case scenario with this option is that you lose all $7,395 you paid for the premium, your break-even point, remember, is the price, the strike price plus the premium you paid. So $620 plus $73.95, which you can see there, $693.95. But the maximum profit in this case is basically unlimited. So if Tesla stock is trading at $1,000 by the 20th of August, your profit is going to be huge. And the profit only goes up the higher that Tesla stock is by the expiration date. There's really no ceiling. Okay, next, let's go over selling calls, and let's start off with selling naked calls. So instead of buying a Tesla call option, what if you want to sell the call? Well, in this case, you'll be paid the $7,395 as a premium from the buyer. But of course, this premium's not free. Nobody's going to give you money for free. So in exchange for receiving this money, you are agreeing with the buyer that if the buyer wants, you have to sell them 100 shares of Tesla stock at $620 a share each. So at any point between now and the expiry date of August 20th, 2021, if the buyer wants, you have to hand over 100 shares of Tesla stock to them. So let's say you like living on the edge and you don't actually own 100 shares of Tesla stock. This is why this is called a naked call, because you're basically running around butt naked with no shares of Tesla. So if you don't actually have the 100 shares and the buyer decides to exercise the option, you will be then forced to buy 100 shares of Tesla stock on the open market at whatever price they're currently trading at. So just like running around naked is not a generally advisable strategy for a good life, selling naked calls is also really not a good strategy because you can get yourself into a lot of trouble. So your obligation at expiry is to deliver 100 shares of Tesla to the buyer. Now, the big danger comes in where if you don't actually own the shares, but the share price of Tesla when the buyer decides to exercise their option is greater than the $620 call price, you'll then have to buy Tesla at whatever price it's trading at to fulfill your end of the obligation. So let's say Tesla's trading at $720 a share. You'll have to buy the shares at $720 and give them to the buyer for $620, and you'll be down $100 a share. Now, of course, the higher Tesla stock is, the more you can lose, and your losses in this case are basically unlimited. It's almost the opposite of buying a call option. The premium you can collect from this is the $7,395, or the premium multiplied by 100. And your profit or loss in this case completely depends on what Tesla is trading at when the buyer decides to exercise their right. So the more expensive Tesla is when the buyer decides to exercise their right, if you don't own the shares, the more money you will lose. So here's a graph for the naked call. As you can see, your maximum profit is just the premium that you receive. Your break-even point is the same, which is your call price plus the premium per share, but your maximum losses are unlimited. So for this reason, you should never sell naked calls because you can get yourself into a lot of trouble and the risk benefit is just simply not worth it. And last, let's talk about selling covered calls. So this is where you actually own the 100 shares of stock. And you can sell one call contract for every 100 shares of stock you own. In this scenario, you collect the premium upfront. So in our example, that would be $7,395. And then you basically just have to wait either for the call to expire and be worthless on the buyer's end or for the buyer to exercise their option. The ideal scenario here, if you're selling a covered call, is that the stock never reaches the strike price. So in our example, it would be Tesla stock never gets up to 620. You have collected the premium and you get to keep your shares at the same time. You don't have to hand over any shares to the buyer. Now, the maximum loss potential here would be if the stock went down to zero. So you would lose out on your cost per share of what you paid for the stock. So let's say your 100 shares of Tesla that you own, you bought at $500 a share. That would mean worst case scenario, if Tesla went to $0, which is still very unlikely, but it's theoretically possible, you would be down $500, but you were paid $73.95 per share by the buyer. So you would be in the negative $426.05 per share multiplied by 100 shares, which is $42,600. And the strategy with selling covered calls is basically when you own a bunch of stock, you are not expecting the stock really to move in the short term. You're maybe expecting it to trade sideways, but you still want to generate income off of the stock you own. So you sell covered calls expecting them to not reach the strike price. So you're continually collecting premiums. With those premiums, you can buy more stock and then sell more covered calls and basically just repeat that cycle. And it's like an infinite money printing scenario if it works out in your favor. But if the stock does run and does reach the stock price, then you will have to hand over your shares to the buyer. And in this scenario, there's no unlimited gains and no unlimited losses, but the possible losses and possible gains are significant on either end. So again, if you're thinking about doing this, I really suggest you sketching up this graph and working out the numbers. So your break-even point is how much you paid for the stock minus what the buyer paid you in a premium per share. So you're basically into the stock with each share at $426.05 in our example. Your maximum profit here is the strike price minus what you paid multiplied by the 100 shares plus the premium you received. So if everything works out for you and the stock never reaches the $620 strike price, you will be up just over $19,000. And the maximum loss scenario here is rather unlikely, but it is still possible where the stock goes to zero. So you've lost out on all the money you paid for the stock initially, which in our example was $500 a share for Tesla stock multiplied by the 100 shares in one call option contract. But you did receive a $7,300 premium, so you're in the hole $42,600. So what's the end point here? How do you exit the call option contract? Well, basically there's three ways to close the trade. The first way is to just wait until the expiration date comes up, and then whatever the stock is trading at, whatever price the stock is trading at per share on the expiration date will determine how much profit or loss you make. The second thing you can do is you can sell the call before the expiration date, in which case your profit or loss will be determined by the price of the shares on the date that you decide to sell. And the third way is to exercise the call, and in this way you receive 100 shares of the stock at the strike price of your option. So a couple words of advice when it comes to call options. Number one, don't get yourself into scenarios that have unlimited losses. It's never worth it. Number two, know what you need to hold. So for example, in the covered calls, you know that you need to hold at least 100 shares of that stock. If you're not holding the stock and it's a naked call, that's when you can get exposed to unlimited losses, and just avoid this. It's not worth the risk. And if you're going to get into options, really understand what you're doing. At the bare minimum, you should understand all the terminology, and you should sketch up some of those graphs of your maximum loss, your break-even point, and your maximum profit scenarios to make sure it's a risk that's worth taking for you and that's something that's feasible for you. And of course, the 3 simple steps when it comes to call options are: know when a stock is going to go up, know by how much the stock is going to go up, and know how to trade options. 3 very simple steps, but very tricky at the same time. So I hope you guys enjoyed this video. Like it, subscribe if you're new, and I will see you guys in the next one. Bye.